I just want to welcome everyone to our first workshop of 2023. I'm here at Movement, Join the Movement Studios. Want to figure out how we wanted to start the year off, and one of the key things about movement is about amplifying, Black wealth, right? So owning homes is at the core, really, of like generational wealth and like being able to pass that wealth on to like family, like once you're gone, right? But even with me, like I've gone through the home buying process, and the home buying process, the way I look at it is the agents get all the shine, right? The agents get all the shine in the game, but at the end of the day, like I feel like the mortgage loan officer is like the key to the whole system.
It definitely.
Like, you know what I'm saying? You could look at 1,000 homes, but unless you have that pre-approval letter, or in that pre-approval, like there's nothing you could do. Like, you know what I'm saying? So with that being said, I wanted to start the year off with this event, and it have Blake. Blake is one of the best in the area, in the DC area, as far as like loan officers. So Blake, I want to thank you for taking the time out of your busy schedule to sit down with us, and give some games. So with that, I want to thank you, man. So I'm gonna let you introduce yourselves, and what you do.
So my name's Blake Price. I grew up in the area from Suitland. I went to Archbishop Carroll High School. I've been in the mortgage industry for about 6 years now. I got into the mortgage industry kind of by default. My family kind of was in real estate. I was an engineering major. But as Anwar just said, basically just building generational wealth. It helped set my mom up for, retirement and things of that sort when she really didn't have any set plans or, hadn't really done her due diligence while she was younger in her younger ages.
Yeah.
So, basically the equity she built up in the house basically helped set that platform for her to be able to retire in a few years. So being on this side, it's fulfilling to help people get into houses.
Okay.
And build that generational wealth. So I enjoy doing that for sure.
I bet. I know you got a PowerPoint, so we're just gonna let you kind of just.
Okay.
And as you go through, we'll stop. We'll have some conversations. Let some people have some questions.
Yep.
Please, if you have any questions, ask. And then also I'll ask. So
you can go to the next one.
Cool.
Yep. So pretty much, for buying a house, basically, it's not as extensive as people may think, right? It's just about the education. We're just not educated. We know a lot of people lack financial literacy because these are things we aren't taught every day in school or anything like that. So
yeah.
It's just a new concept to people, but it's pretty straightforward with, buying it. So just gaining knowledge, understanding credit, basically understanding what documents you may need for buying a house, just so you can have all of those prepared and ready for whenever you are ready to pull that trigger to get into the home. Basically knowing the programs, knowing some of the vocabulary that you may hear attached to the home buying process, just so you understand how everything, so nothing's going over your head, just so you are fully aware of everything. Budgeting, right? Understanding what you can afford, being conscious, and really we sit down and we really try to get our clients to understand and think about all of their money that they spend monthly, where they can cut back some things, and making sure that they're comfortable in when they buy a house, so they're not house poor, right? And then just some of the do's and don'ts throughout the process. That's pretty much, from top to bottom what we try to educate our consumers on.
Okay.
All of that throughout the whole process to make sure that they are ready to buy the house, and not just buy that one house, be able to buy another and another if they want to, for sure. Because life happens, you start to upgrade families, you get married, have kids, so now being able to set that next play up.
All right, cool. So, gaining knowledge about what there.
Yeah. Yep. So, I would just say, in reference to gaining knowledge about, the real estate market, is just about doing your due diligence and knowing just how we were kind of talking about just know where you want to purchase, you know, what you're looking for, right? Because every area is going to be different. It's about what speaks to you internally as, you know, your family makeup, who you are. I got some people who have kids, so school districts are a big thing for them, right?
For sure.
So having educational, what school district you want to be in. You might be a bachelor. You might just want to live the city life for a while, right? So you might want more space. So you might want to go into a more rural area. More quiet, real peaceful type thing. So just gaining knowledge and then also understanding what programs are out there for you.
Yeah.
Like a lot of times what I would say that I'm not a big fan of in the mortgage industry is a lot of loan officers will take the easier route and push people into like not going with the first time home buyer program.
Yeah.
Because going with the first time home buyer programs takes way more documentation.
Yep.
Right. So it's a little more strenuous for them on for their job. So they're like, no, well, we rather just have you bring your 3%.
Yeah.
When any down payment assistance. So unless you bring it up, they're not going to.
Yeah. I think like when the first time I attempted to buy a house, like I hooked up with a loan officer. And like, because I wasn't at the finish line, he didn't do anything to help me get to the finish line. It was like, you're not at the finish line. So like, you on your own. When you get here, holler at me.
Exactly.
You know what I'm saying? The second time around, like I met with somebody and like the first day we got on the phone, he pulled my credit. He was like, all right, you are 6 months away from doing it. Do X, Y, Z, and we good. You know what I'm saying? So I think like in our community, that's kind of what we need. We need like more agents who are willing to kind of like walk us to the finish line versus just like, yo, only come if you're ready.
Oh yeah, for sure. Now definitely. So that's one of the biggest pieces I focus on is like credit repair. I try not to let it drown my business, right?
Yeah.
But I also know in our community that is an issue, right? So people not being educated on how credit works, on what things to do. So anytime I do get somebody who is on a lower end of the credit score spectrum, I try to educate them as far as credit utilization, understanding how to use your credit card, how those reports to the credit bureau, helping them understand collections. Collections are a big thing that I think a lot of people don't understand on how they work.
Yeah.
Did you want me to tap into that?
I mean, we could let's kind of like
we can go through.
We're looking at what we got, right?
Yeah. So with the credit, so basically collections is a big thing that taps into that. Of course, on-time payments, length of credit, right?
Yeah.
So that's another big thing that I don't think people understand. Because I see a lot of times where people will have a credit card that's closed out, but you've now forfeited all of that good credit that you've had. But with the credit, we're trying to mainly get people to a 640 credit score.
Yeah.
640 credit score opens you up to all the first-time home buyer programs.
Yeah. I mean, so it does get you there, but then also like if your credit isn't a 680, isn't a 640?
Yeah, 640 is basically gonna open you up to all the terms. But the higher your credit score, now you open yourself up to way more options.
Yeah.
So way better rates, lower mortgage insurance. It's just a lot more benefits that come once you are above that 680 threshold.
Yeah.
But we can go as low as 580.
Yeah.
I don't advocate.
You don't advocate for 580
because you're gonna take the interest you're gonna pay to my company.
Yeah.
It's gonna be astronomical where you're barely paying off your loan.
Yeah.
Right? Because you're paying so much in interest.
Yep.
So that's one of the big things.
What else we got here? Go ahead.
Yep. So one of the questions up there is why is the score I see higher? Right? So if you log into your Credit Karma, if you log into some of these other agencies, they are doing a credit card based algorithm. Right, so they are weighing certain things about the credit differently than a mortgage-based algorithm will. So a mortgage-based algorithm, sometimes we'll have people that say their score was lower on Credit Karma, and then we pull in it's actually higher. So things are weighted differently on some of those platforms.
I always say Credit Karma is lying to us, bro.
Oh yeah, for sure.
It's it's in the DC we have sicing it, so it's like it's sicing you, you know what I'm saying?
Exactly.
So it's just kind of it's hyping you up for no reason, but I mean there's a reason you get the cards, but for like mortgages it's not.
Exactly. So what I use Credit Karma is just to check my report continuously, just to make sure nothing is reported inaccurately on there. making sure they didn't, no collections hit my account, anything like that. So that's what I more use Credit Karma for. Of course, it'll kind of give you a baseline or where you think you're at, but most of the time it's not going to be accurate. But if you like going for a credit card, it might be more in the line of that's where your score can be at and things of that sort. If you apply with like a lender institution in that capacity.
One of the things that I did was I signed up. I got the My FICO joint, and just it's like $40 a month, but like it's probably the most accurate.
Exactly. FICO, you definitely
Yeah, it's the most accurate for sure for you. So
yep. But that's why people see higher. That's why you see other higher scores on like different platforms like that. Then the next question up there: do late payments affect my score? Late payments are the biggest deterrent to, your credit score. I mean, that shows your ability to repay a loan. So we are, as the lending institution, we're lending you the money, right? We want to be able to make sure that we want to be able to get back our money that we're investing into you. So if you are showing late payments, that is what drastically, affects the score, of course.
Yeah.
Yep. So that's the biggest piece of credit. Next question up there is, does the balance of my credit card matter? So yes, that is one of the biggest pieces, right? So I think that's the most understood. Most of the time people get credit cards and they utilize all of their credit.
Yeah.
Right? And basically how that's weighed on the credit report is 30% is a solid amount to be at of utilization, but 10% is the best.
Yeah.
So being at 10% of your total balance. So to explain that, if we have a $3,000 credit card, right, you don't really want to go over 300. You can go over 300, but you want to pay it off before that reports to the credit.
Yeah, yeah.
So let's say your statement closes on the 26th of every month. If that money if it's sitting at $1,000 on that credit card on the 26th of that month, that's what they're going to report to the credit bureaus. So now that's going to drop your scores a little bit.
Yeah.
But if you pay it off on the 25th, back down to 300, then it'll boost your score because you had that 10% threshold.
Yeah.
So that's a big thing that I see with people is like you'll see utilization at 70, 80, 90%. And I'll show them what their score can be once they pay off the credit card. And it's usually a chunk anywhere from like 20 to 50 points, just depending on what else is on their credit.
Yeah. All right, cool.
Yep. And then what are different types of credit? So any loans are reported on there, any revolving debt, any credit cards. And one of the biggest things I would say that I would educate people on is, I feel like in our community isn't a big thing, but in other cultures I do see it a lot, is being able to put your children on authorized user cards or friends and family, right? If you got a grandmother that has 15 years of good history or a credit card, benefit from that.
Yeah.
If she puts you on the authorized user, you get all of that good history. Now, be careful who you go on the authorized user card with, because you get the bad history too. If you're on there and they not making on-time payments and things of that sort.
Yeah.
So that would be one of my biggest things I would say is a different type of credit that we aren't usually aware of to help increase your scores for sure.
All right.
Yeah.
Documentation required.
So documentation, that's the biggest piece of the pre-approval process, because we're going to double confirm everything about anything you told us on the application, from your income to how much money you got in the bank to what jobs you've worked. So pretty much we want a 2-year history. So matter of fact, we'll just go in order here. We got driver's license. So basically we want your driver's license just to show that, to match up your social, make sure your name is reporting accurately and everything, because once we do close on a loan, right, we are filing this paperwork with the city for a deed for other purposes that are associated with it. So a misspelling of a name could cause a big issue with, that being your real ownership of your property if the name on the deed is totally wrong from which your actual name is.
Yep.
So that's the reason we ask for the driver's license. We ask for 2 years tax returns. So sometimes we don't need this if you're W-2, but sometimes we will need it based on the program. If you are self-employed, we always want to need 2 years of tax returns. Yeah. But let's say you are a W-2 employee and you have a side business, you do hair, you drive Uber, whatever it is, you're filing a Schedule C most likely. So we do need to look at your tax returns for that purpose. Then if you are a W-2 employee, we do need your last 2 years tax returns just to show what your final year's amount that you made in the past 2 years, right? And then we need 2 months of bank statements. That basically shows us what you currently have in the bank. That shows us that you have the ability to afford the closing costs and down payment associated with it.
So one of the things about that is like, you don't want to have your bank account go in the negative, or any kind of like, what's some fees?
Overdraft.
Any kind of overdraft fees. Because like when it happened to me, so like when I bought my house, I had set up automatic savings accounts from one account to another, and the automatic.
You were just pulling from there.
So it just put me in. So I had to go through and like explain
every single one.
They was like, yo, we wanted to hold next 6 months. The last 6 months, you got to explain every single thing. So like, that's one thing. Another thing is, this is kind of one of the tricks my guy told me. He was like, yo, let's say your down payment is like $10,000. Let's say you don't have it or whatever. If somebody loans you the money, if you have the money more than 30 days, is your money.
Yep, for sure.
So like, you might want a house. I'm like, all right, cool. Here go 10. Here go 10. Put in your account just so it's there. After 30 days, it's now your money, and you don't need to explain where the money came from.
Exactly.
So that's another thing that we don't necessarily know on this side.
Yep. Another thing is like getting gifts. So you can get gifted money from family members throughout the transaction. So a lot of times we'll see grandparents or parents try to help, even if it's $500 or whatever it is. That can be documented. It can be contributed towards your down payment and closing costs. So that's a big thing. And then we have pay stubs. If you are a W-2 employee, we do need your last 2 pay stubs just to show 30 days of history showing that you're still currently working. Then we have, so if you were previously divorced or separated, basically 2 of the things that do run hand in hand is basically like any child support or any divorce docs we want to see, is because we want to make sure that there was no liabilities that aren't reporting to credit that are associated. So let's say there was somebody who was paying alimony, right? But it wasn't on their credit. We want to make sure that that's not a liability that's attached to them, that they couldn't afford the house anymore. And then a big piece is the 401k statement. So I think a lot of people aren't aware of that. I'm a big fan of it if you don't have the money, right? So 401k, you can borrow from your 401k to buy the house, right?
Also, if you could borrow from your 401k, can you also borrow from your life insurance policy?
Yes. So if it's vested enough.
Okay.
It has to be vested enough for you to be able to borrow from it. But 401k, the 2 reasons you can borrow from your 401k is financial hardship.
Okay.
You have to document if you like lost your job or something, or buying a primary residence. So if you buy a primary residence, you can pull from it. And a lot of people ask me, what's your thoughts on pulling from it? But let's just say your market return on your 401k might be at 5%. Right now in our area, like the way stuff is appreciating, you dumping that into a house probably will yield you more return
in the long run, for sure,
than your 401k. For sure. So that's definitely something that a lot of people aren't aware of, that you can't pull from that. So I always tell people to try to max out on it if they can. So vocabulary, just what I was saying about understanding everything, to kind of run through these. So the first one says debt to income ratio. Debt to income ratio is your debts to your income. All right. So we're going to look at your total gross income. We don't look at net income. We look at gross. All right. Before taxes come out. And then we compare it to your debts. Right. And to see what you're able to afford. So basically the future mortgage payment, and then your monthly amounts that you pay on each one of those. So we're not worried about, you can have $100,000. You can have $100,000 loan, but if you're only paying like, let's say $200 on it, then that's all we're counting against you on that as a liability monthly. So we're looking at the monthly amount that you make per month, and then the monthly bills that you have to see if you can afford the mortgage. So that's what DTI means. Housing ratio is
to that.
Go ahead.
In terms of these, like honestly, credit card debt is probably, you know, I guess we're trying to think of ranking. So credit card debt probably is not good because it's consumer as opposed to like having student loans, or is it?
No, I know it's still the same. Actually, student loans might be less beneficial, right? Because what happens a lot of times with student loans is student loans are in deferment. People have different type of repayment terms. So what is looked at is when you're going with a program which we'll talk about later, is called FHA. FHA makes you take 0.5% of whatever your total student loan balance is and use that as a debt against you as opposed to whatever you might be actually paying. So let's say you got $100,000 in student loan debt, right? You might be paying $200 a month on it, but FHA is going to make us use $500 as a debt against you to play it safe, to make sure, because that $200 is not going to repay $100K during your lifetime, right? You're paying $200. So that's kind of what that goes into play.
So what my loan officer did with like my student loan was, I think at the time I was paying like $4 something a month on my student loans. And he made me stretch it out as far as I could stretch it out. So like my student loan plan is like 25 years or something. Like
exactly,
it's like whatever, but it like lowered my payments to like $200, and that, like, you know what I'm saying. So there's so many different things you could do. Like, you know, when you have like a loan officer that wants to get you to the finish line, there's so many tricks to the game.
It's definitely so many tricks. So that's one of the other things I would say to piggyback off of that is, so there's two different loan programs that a majority use is FHA and then conventional. FHA doesn't allow you to use the actual payment, but conventional does. So like what he was just saying, if we go conventional, if we above that 680 threshold, we now can take you with a conventional loan. So now, let's say I get somebody who's on an income-based repayment plan, and they got $40,000 student loan debt, but they don't make that much money, so they actually pay $50.
Yeah,
I can use $50. Whereas FHA, I got to use 0.5% of the total student loan balance as a liability. So that's where some of that comes in differently. Next update was housing ratio. Housing ratio is just your ratio, your income to basically just what the new housing payment will be. So that's what we call the front end ratio. Down payment, of course, as most people know, is the down payment from, depending on what program you're going to use, the sales price times a certain percentage is what you will have to put down on the property to have skin in the game, right? Closing costs. Closing costs are usually costs that are associated with you closing on the home, from title company fees to lender fees to real estate fees and things of that sort. So me as a loan officer, I tend to break those down very extensively, especially because I work with a lot of first-time home buyers. A lot of people don't understand what goes into closing costs.
Yeah.
So that's a big thing. Cash to close. So in the real estate transaction, if you hit cash to close is referring to how much money you need to bring to the table at the table to get into the home. So that's including your down payment, your closing costs, and if you're getting any down payment assistance, that will be associated with that.
Yeah, there's so much that goes into it. I think, you know, you all the inspections and stuff like that, you got to pay for it.
Exactly.
There's a lot that goes into it, but, you know, but also, like, you know, the seller, depends on the kind of market that we're in.
For sure.
The seller will offset some of that. I think when I went to the market, the seller gave me back more money than I could even use.
Exactly.
So like I use that to buy a home warranty.
Okay, yeah,
you know,
yeah, exactly. So you went conventional, so they probably gave you more than 3%.
I went FHA.
You went FHA? Okay, so yeah, they probably gave you a ton of money then. Yep. Yeah, exactly. So yeah, you can use that in other facets and other ways, like you just said, with a home warranty or something like that. For sure. Then loan programs just refers to basically different home buyer programs, different financing options that we have. We have mortgage insurance. This is a big thing that I always like to talk about. I feel like it's probably the least understood thing in the real estate transaction. So mortgage insurance is insurance that insures the lender in case you ever default on your mortgage. All right. So that ensures them, if you defaulted, we now can recoup our costs back because you defaulted. So the higher your credit score, it works just like car insurance, right? So the higher your credit score, the lower your mortgage insurance payment is. All right. So basically, it's less risk associated with you because you have such a good credit score that it's less likely that you will default on your loan because of your history.
And are some of the like first time home buyer programs they don't have that as a thing?
Some of them don't have that. Not as many as they used to, but like post COVID, some of them kind of cut that out. But let's just say I'll give you an example. So let's say we had a 680 credit score, right? And let's say the mortgage insurance premium is $200 a month, right? But let's say we got somebody who's at a 760 credit score. Their mortgage insurance premium might be $60 a month, right? So that just having that better credit score just helps save them $140 a month. So, because there's less risk associated with that. So you can get rid of mortgage insurance either by paying it up front at the beginning of the transaction, putting 20% down at the beginning of the transaction, or once your home increases in value above 20%, and 20%. So let's just say let's say our home appraises at 100,000. If our loan amount is at 80,000, we're at 80%. So now we got 20% equity. I no longer have to have mortgage insurance. Yeah. So that's something that's big that a lot of people don't really understand what goes. Hey, what is this extra payment on here? So that's definitely a big thing for sure. Well, I think I'm gonna get it up on mine too. Yep. So types of programs. So basically you have USDA. A lot of people in our area are not familiar with USDA. USDA is a rural product, right? So it's basically for areas that don't have much density, don't have much population. So certain parts of Charles County in this area are eligible. So basically there's a mapper that will tell you what is USDA eligible and what's not. The good thing about USDA, there is no down payment attached to USDA loans. So I'll have some people who might go out La Plata, who might go out certain parts of Waldorf, and they don't have to have no down payment attached to buying a house. Yeah, so that's dope. Yeah, so that's a great product right there. And so on the mapper, if you ever type in USDA mapper, you can look up any of the eligible areas where those homes are eligible. Sure. FHA is a loan for more lower credit scores, right? It offers good financing options for people who are on the lower end of the spectrum on the credit score. Is a 3.5% down payment attached to that. Now, with an FHA loan, that I think a lot of people don't understand with FHA is you can't get rid of mortgage insurance. You cannot get rid of mortgage insurance, the mortgage insurance we were just talking about. So if you ever wanted to get rid of it, you would have to refinance to conventional to be able to get rid of that. So, but I would say pretty much probably makes up about 60% of my business for sure, using FHA loans. Conventional is for high credit scores. Once you usually cross over that 680 threshold, a lot of people will take with a conventional loan. And the reason being is because of the mortgage insurance. Yeah. Because now you're on the higher end of the credit score, so now your mortgage insurance payment will be lower, which will now help you get a lower monthly payment than going FHA. And then you have VA. So if anybody who, if you were National Guard, if you reserves, Marines, Navy, Air Force, you qualify for a VA loan. And there's no down payment attached to that, and no mortgage insurance.
Okay. Oh, that's dope. Okay.
Yeah. So anybody who, I want to say reserves and National Guard might be 3 years. I think 3 years season.
Okay.
Yeah.
Because they're not full-time active duty.
Yeah.
Yeah. So if you're full-time active duty or any of those other branches, you basically qualify for no down payment with a VA loan.
I bet.
I mean, he could.
All right, cool.
Yep. So just as I was talking about with the FHA, so down payment is 3.5%. You will have monthly MI, and there's lower credit score requirements. So like at my company, we can go as low as a 580 credit score, to be able to get you with FHA financing. And what we're just talking about with seller concession is money that the seller can give you out of their net proceeds to help you pay closing costs. All right. So you can get up to 6% in closing costs assistance from the seller on an FHA transaction. There. Then with conventional is a 3% to 5% down payment. 3% is triggered when at least one person on the loan transaction is a first-time home buyer. So you can go as low as 3% down. So even if there was somebody else who owned the home before and the spouse hasn't owned, they can go 3% down. All right. And 5% is if you owned another home already, and it's not your first time buying and you don't have anybody else on the transaction who's a first-time home buyer, it triggers a 5% down payment. Right. So then, as I was talking about the mortgage insurance, you can have monthly, you can finance it into the loan amount, or you can pay it up front. So that's where conventional loans become a little more beneficial than FHA. 680, and you can go lower than 680, but 680 is usually the trigger. So let's say we got somebody who has a bunch of cash in the bank. Yeah. They can go down to 640, but they might need to put down 20% to be able to go conventional. So for most of my clients, they need to be able to be, I deal with a lot of clients who don't have a lot of money in the bank. So being able to go 680 allows them to only have to put 3% down.
Okay.
And then the seller
5%. That exactly. I think like a lot of people like just think you have to put down all this money
for sure.
You know what I'm saying? And yeah, you know what I mean? I think when I closed on my house, I think like out of my pocket, I only put up like 6,000 or 7,000.
Yeah,
and I bought a house at DC.
Yeah, exactly.
You know what I'm saying? Like, just think about that.
Exactly. I was the exact same. My very first, I got just like you. I got 3% covered in seller concession. I used the down payment assistance program. I ended up bringing like $3,000 to the table.
Yeah,
you know what I mean. So just knowing how to maneuver and understand the programs and do that, you can literally limit how much money you got to come out of pocket for sure.
Yeah, I think it just comes down to making sure like your financial wheelhouse is in order. Mm-hmm. Once you get that together, you know what I'm saying, then like
exactly,
then actually getting the property itself.
Exactly.
So.
Yeah. Then VA financing, of course, must be a veteran. Guarantee fee is based on the eligibility. So for instance, if we have somebody who is disabled or like suffering from PTSD or they have any type of disability from them being in service, they don't have to pay the guarantee fee, which usually comes up to about 2%, almost about 3% of the sales price. You can go as low. We can go down to a 580 credit score. It don't have to be a 620. Honestly, but 620 will be the threshold to get the better rates, of course, for somebody. And then they can get up to 4% in seller concession.
We probably go.
Yeah. But this is actually a very good one. So Maryland Mortgage Program. So this is a first-time home buyer program. So this is maybe my favorite. Well, I ain't gonna say my favorite. My second favorite, probably behind HPAP. But Maryland Mortgage Program is a state-based program that gives you down payment assistance, right? So up on the screen you'll see there's basically options for 3%, 4%, and 5% down payments, right? To go towards your down payment. So let's just say, right, we're doing a conventional loan that's a 3% down payment because you're a first-time home buyer. Let's say closing costs come up to about 4%, right? So, and we buy a $300,000 house. So now we go with the 5% option with Maryland Mortgage Program. So that covers your 3% down payment and then it covers 2% of your closing costs. So now it's 2% left over. We're buying a $300,000 house, and now just how you were just saying, now you bring $6,000 to the table to buy your first house.
Yeah.
Yep. So it's super beneficial. Now I will give the caveat with going with the first time home buyer program. The pros are you're going to bring way less money out of pocket.
Yeah.
The con is you do have to pay the money back.
Yeah.
Right. But you don't have to pay the money back until you sell the home.
Okay.
So once you sell the home, so I would give people the same example. So let's say we buy the $300,000 house. The down payment is $9,000. We stayed in the house for 5 years. We were paying down on the mortgage. We owe $250,000.
Yeah.
The program gave us the $9,000. So now I want to go sell this house. So now my house is now worth $350,000.
Yeah.
5 years later, right? So now I pay back $250,000. You would pay back $250,000 to my company, and you would pay back $9,000 to the state of Maryland. And now you would take the difference between that $259,000 and when you selling the house for $350,000. Now that's all your profit that you walk away with.
Learning a lot.
That's good. That's the purpose.
Yep. So Maryland Mortgage Program is very beneficial. Majority of my clients and you don't have to purchase in no particular county. Now each county has different income limits in the area, which is why you'll see that there. So Montgomery County, Charles County, PG County, all have the same income limit. Whereas Anne Arundel, Baltimore County, Howard, Baltimore City, all of those are a little bit on the lower end of the spectrum.
Okay.
Yeah. So that's where we'll come. You'll now apply with us. We'll look at what your income is. We'll kind of educate you, because sometimes that might make the difference. If you go to, I might have some people that like, I kind of want to be in Howard or Montgomery.
Yeah.
And now I tell them they over the income limit, and now that makes them go to Montgomery. So now it kind of helps educate them to make the best possible situation so that they qualify for the program. Yeah.
Okay.
So, you want to, you got DC programs in here? Or you wanna...
So now I'll just tap into the DC program. I know like off the back of my hand. So FHLB is a program that will give $7,500. All right. So you got to be under a certain income threshold also. So they have income thresholds. It gives $7,500. And then for police, firefighters, nurses, and teachers, it will give up to $10,000. Yes, and it is a grant. So the difference between
EHAPing.
Huh?
That's EHAPing.
So EHAP's a little different. But yeah, I'm gonna talk about EHAP. So with FHLB, basically the difference when you will see first time home buyer programs that say a loan versus a grant.
Mm-hmm.
A loan has to be repaid.
Yeah.
A grant doesn't have to be repaid. So that money's fully forgiven from the time you close on the loan. You don't owe that money back at all. So if you went with this program, you wouldn't have to. Now the only caveat about this program, the income thresholds are very low here. So like it might be like we had like 50, 60,000. So a lot of people in this area usually cross over that, but there are some people who qualify for sure, definitely. Then next, it is on the screen, but DC Open Doors is exact same as Maryland Mortgage Program. That's just the DC based version of Maryland Mortgage Program. So they basically fully cover the down payment for you, and they also give you reduced mortgage insurance. And then they have something that is very beneficial that's called a mortgage credit certificate. So to explain a mortgage credit certificate is you have to apply through them to get that, but I wish I had it. But you gotta be a first time home buyer. But you get back 25% of the interest paid on your home loan back at tax time.
Oh, for real?
So if you pay 25% of the interest paid on your home loan throughout that year, you get it back at tax time.
On the federal side or on the or from the city side? Okay, cool.
Yeah, the state side. So if you pay $10,000 in interest, you get back an extra $2,500 back at tax time, and it's not a one-time thing. It's like through the duration that you have in that home. So some people won't even sell their home because they keep getting that money back at tax time, or they rent it out or do something like that.
Okay.
Try to do that. So that's DC Open Doors, HPAP, which you were talking about, and EHAP. So EHAP is for anybody who is a state employee, a DC employee. EHAP will give $20,000 towards down payment and closing costs for being a DC employee.
Okay. That's anybody that work for the DC government.
DC government.
So it could be a ticket.
Exactly. Yep. DC government. They could be a school teacher. They could be whatever. They work for DC government. They are eligible for up to $20,000.
Actually, the ticket. D-Dot is hiring more ticket people. If you're looking for a job, get a job in 20K. It works.
Right. Definitely.
They work for DC government for a year.
Yeah, I mean,
Yeah, exactly.
for real.
Yeah.
Okay.
If you start today, you can get it today.
Exactly. And then you could partner that income combination with HVAC.
But so as EHAP, do you have to be a first-time home buyer, or that could be? It doesn't matter.
That I can't remember the guideline. If I believe you can, I don't believe you have to be a first time home buyer, but you cannot own another home at the time of
Okay.
release.
All right. Cool.
Yeah.
So you can't use it to get you all your invested property.
Exactly. So then you can put it in conjunction with HPAP.
Okay.
So HPAP is another program that you qualify for. You don't have to be a resident of DC. You don't have to work in DC. You just have to be buying a home in the District of Columbia. And HPAP is giving up to $202,000 towards down payment and closing costs. Mary Bowser made that effective October 1st.
And that's a first-time home buyer.
That's all first-time home buyers. Basically, the thresholds is income based, so it's tiered.
Uh-huh.
So you can qualify for up to $202,000.
Okay.
But then it goes down to I believe 171, and then 141. Then I think it's 101. Then 80, and then 70,000. So the least I think you qualify for, and I think that threshold. Now, of course, how it goes is what I like about HPAP is it's just not a flat number, but the more people in the household, you can make more money.
So it's based on a household income.
Based on the household size.
Okay, that makes
So
sense.
let's say you got one parent that has 3 children. That's now a household size of 4. So she can make more money than a person who just lives by themselves and qualifies. Right. So.
I think I'd read something a couple years ago. It's like 40-something first-time home buyer programs for people in DC.
Oh yeah, for sure.
And that was tweeted out by somebody who worked for the DC government. But it's finding all of them and putting them all in one place, and I think that's the thing. It's they're there.
Exactly.
They might not all be for you, but you know what I'm saying. But there's
they're definitely there.
Yeah, they're
definitely there for you to be able to utilize, and that's just where the education piece come in. I'll give you an exact example. I got one HPAP deal working right now. Probably gonna close next week. She's getting $20,000 from EHAP. She's getting $141,000 from HPAP. So she's getting that. She's getting $161,000. It's about a $450,000 house. We put down 10% on the property. Put down 10% on the property. Bought her rate down. Did all of that. She's bringing $0 to the table. And she just bought a $460,000 in decent.
Bro, y'all see what is happening out here.
Exactly.
Because of y'all was happening.
Yeah, it's a no-brainer. Now, the only caveat I would give about HPAP is it's not something. That's why we kind of having this right here to help you prepare, help you educate yourself. Is you don't want to wait to the last minute to try to get HPAP. Because if your lease is about to be up in 30 days, it's going to take you longer to get approved for HPAP in 30 days. You might be looking at a 60-day process for them to take you through the counseling, analyze your documents before they issue your approval.
Any evidences that the earlier you start with any of them.
Yeah, so your HPAP approval can last for up to a year. So basically, I always tell people to start 3 months out before you know you want to move, and kind of start getting all your stuff in order. Because let's just say you need to fix something on your credit, or you need to address anything. It kind of gives you more wiggle room. Because a lot of times I'll get people who come to me as soon as their lease is about to be up. So now your back is against the wall.
Yeah.
So you can't fix something in time. Then you're going back and signing another 12-month lease, and then putting yourself back, down the road. And I actually had a lot of people who did that in 2019, right? I had this girl, she actually called me. It's actually yesterday. She called me yesterday. She was going to buy in 2019. She was looking at this townhouse. She got cold feet. It was $250,000. That same house right now, today, is worth $350,000. So she would have had $100,000 in equity just in that property.
Yes, that's how things is moving, man. I feel like like I bought my crib and then like within like a year it was like 75K in equity.
Exactly.
Like just like that. It's crazy.
It's literally crazy. So that's why just buying real estate just helps you leverage so many different things to be able to, do whatever you want to do out here for sure. This next program is called VHDA. VHDA is the exact same as DC Open Doors. And Maryland Mortgage Program is just the Virginia option. So if you were looking at buying in Virginia, it'll give you up to 2.5% towards your down payment, or 2%. And basically, there's rates fluctuate. So if you get more assistance, of course, it's gonna be a higher rate. But theirs is a grant. That's where the difference comes in. So their money is forgiven. And then they do have an option with no mortgage insurance.
Okay.
Or you don't have to have mortgage insurance.
There's also the Maryland ones you mentioned.
Yeah, so all the Maryland ones you do. Yep. Yep.
Better. Cool.
So basically, like I said, I've been in the industry for about 6 years. I actually just started my own mortgage team inside of my company. So I now have a guy who I help bring in the business named Delani Estrell. And he's now like his own loan officer, but he's on my team.
Mm-hmm.
And then I have a loan assistant who works for me, who services both of us. So basically, we will be your home buying team if you did want to get pre-approved or did want to talk about any financing options. So basically, about 10 years worth of experience in the business to be able to talk about us thoroughly, and go through all the options, go through any of your programs that you interested in, any financing options for sure. So contract to close. So I'll kind of give a quick synopsis of what it looks like from the time you start the process to the time we end the process, right? So when you come to us, this is my education. I always tell people, they don't listen though, right? It's come to me first, right?
Mm-hmm.
But of course, most people are socially programmed to go to a realtor first.
Yeah.
So they go to a realtor first, and now you come to me because the realtor doesn't want to show any homes until they know what you're pre-approved for. We now pre-approve you, right? So now we pre-approve you, know what you're qualified for. You start looking at homes inside that price range in whatever area you want to buy. You've now put in a bid on a home, and let's say you win that bid. So now it comes back to me, and now we start the underwriting process, right? So in that same time, you're getting a home inspection. And we'll talk about, so a home inspection is to make sure that you're not buying a dud of a home, that the home is up to code, and anything that needs to be fixed, the real estate agent will go over and try to have the sellers fix those things on the property. If everything goes good with that, we continue to move forward with the deal. We submit you in the underwriting, and we order an appraisal. All right, so an appraisal is one of the biggest things in the real estate transaction because we're fronting you money for that property. So we want to make sure that the money we're fronting you, that the home is worth that. So let's say we're under contract for $350,000 and the home comes in at $345 value. We're not going to lend more than $345, right? So now what your agent is going to do is go back and renegotiate the terms of the deal because we're under a binding contractual agreement, and now we'll get that adjusted to $345,000 to be able to now reduce that so you can buy that home, right? From there, once you receive the underwriting approval, we basically issue you your final numbers and go over your final numbers with you, making sure that you understand what you need to bring to the table is what we were talking about earlier, cash to close. And from there, you basically now schedule your closing, and you go to the table, and now that's when you see on Instagram all the, the keys and the sun and pictures, and the bottles and everything like that are being popped. So, and then pretty much me, also my team, we follow up with our homeowners because now the process doesn't just end there for us. So I'll give you an example. Right now, rates are super high, right? So let's say we close you this month, but rates drop from 6.5% down to 3.5%. I'm gonna call you now because it's a beneficial situation for you to refinance because the difference between 6.5 and 3.5 might save you $300 a month, right?
A lot, bro.
Exactly. So, and not only that, I'm also a resource for my clients long term. They call me for questions about houses, contractors, all types of things. Hey, Blake, my homeowner's insurance. I'm about to change my homeowner's insurance. What do I need to do? So, I mean, I pretty much stay in contact with my clients, you know, from the day we close until years down the road. I'm still talking to clients that I closed the first year in my business.
So for my condo, right, I didn't really even shop around like a homeowner's insurance. I just went with my car insurance. I just
Always shop. So that's
so
what
that's what I'm saying.
yeah.
Should my condo insurance be separate from my car?
Oh, it can. It definitely can be.
All right.
It definitely can be. So one of the things, like I would say, I have some friends who are insurance, who work for insurance companies, right? And one of my good dudes who I refer a lot of business to, he works for State Farm. But me being honest, right? So State Farm's a little high, right? They're the Nike. The you gonna get a little bit of better customer service, but when you really think about it, right? How often do you use your insurance, right? Very seldomly does something happen, right? So
you hope you never use your home insurance.
You never use your home insurance, right? But I use 2 brokers. So brokers, the difference where they vary is they are partnered with multiple insurance agencies. So when they do is they take all your information, they might send it out to 15 different insurance companies, Progressive, Travelers, Liberty Mutual. They might get you 15 different quotes, and now they're going to give you the best possible quote. Whereas you go with State Farm, he can only provide you a State Farm quote. So a lot of times my brokers will beat the prices of that, and it also is based on the area. Certain
It ain't Lake, you know.
Oh no, I doubt. I switched all mine to in DC. Travelers is pretty good, right? So all mine switched to Travelers. I think I saved my car insurance too. I think I saved like $400 a month, like total. Like between all my properties I got, and then when I was like, oh, it's a no-brainer. I'm not paying the extra $400 just before. So that's definitely a good thing. So do's and don'ts. I would say don't go house shopping without knowing what you can afford, right? Because, I mean, that's the easiest way to let yourself down, right? So you go out there and you see the house, but you might not know what the mortgage attached to that is. And then you kind of set the expectations high, and now you're kind of letting yourself down. Don't think you have to go out of the loan for sure. Before you are starting the process, I wouldn't try to open up any new lines of credit, right? I will always consult with a person like me, or reverse. I wouldn't close out any loans of credit until you talk to me, right? And I'll give you an example of why. So I had a client who came to me like, I want to pay off this credit. I want to pay off my credit, this credit card. And I'm like, okay, cool. Let me take a look at it first. They actually had a credit card that had a higher rate, but they had a lower balance on, they had a lower balance on one. So the one that was cheapest to pay off, had the highest payment, right?
Okay.
So I'm like, well, why don't we pay that one off instead of you knocking the big one off, because that helps your debt to income ratio.
Yeah.
So instead of exhausting the extra money, that's where we now could come in and kind of tell you what things to pay down.
You need coaching.
Yep, exactly. So another thing that I'll say with that if you have a installment loan and it's under 10 months on it, so let's say you got a car loan and you only got 9 months left on it, we don't have to count that liability against you. So, for instance, you don't want to go get a new car right there. It's like, because now that might be a $700 payment we don't got to count against you because you only got 9 months left on it.
Yeah.
Where some people might be like, all right, cool, it's about time for me to go look for a new car. I'm almost done with this one. No, don't take on that new liability. No major purchases. Of course, don't quit or change jobs. You can change jobs. We are kind of more looking for you to stay in the same industry. I always have people who call me like, hey, I just got this new job offer. Can I take it? Most certainly, you can take the job. As long as it's in the same line of work, we just don't really want to see you going from like IT to bus driver to IT. You know, we want to make sure, because we want stability there. We want to make sure that you're going to stay in that line of work that is going to be consistent, right? Things I would say, get pre-approved early, so you know, as I was saying, 3 months before you know you want to move, just so you can know what things you want to fix. Picking your realtor, right? That is a huge thing. This is going to be somebody, just how I said, most of my clients stay attached to me for years. This is somebody you need to feel comfortable with. You might be riding in the car with them to go see houses. You're going to be talking to them about your personal business, about things, intimate. So you want to make sure that you can connect and relate to your realtor. So that's one of the biggest things I would say. Make a savings plan, work on a budget. A budget is a big thing, which probably be the next slide is, I can send anybody that who's interested in the budget. And then maintain your current employment and income. Don't go down in income right before buying a house. So that's a big thing. Yep. It said you can go to the next one. And then, if anybody wants to, send you their email and ask for a personal budget, I do this. Like my branch manager, we sit down, we do this every year. We talk about our budget. We see what stuff we can X out. And I'm not going to lie, doing a personal budget is huge. Yeah. I didn't know how much subscription stuff I was attached to. Oh my goodness.
Another thing that Rocket Money app used to be called Truebill, but the Rocket Money app where you connect all your accounts to it, and it just tells you everything. Another thing that does also is like let you know when your bills are due.
Exactly.
You know what I'm saying? So you never miss anything. You're like, oh damn, this bill is due then. So,
exactly.
So make sure y'all download it.
Yeah. So I can send anybody that sheet. Email anybody that sheet that's interested, because I think that has helped transform me, because there's so much miscellaneous stuff that you don't really count into your everyday budget that you kind of will gloss over, really. You know what I mean? Yeah. And so pretty much that concludes everything as far as, the slideshow. So, any questions or anything, definitely, open to take for sure.
What are the grant programs for, like salary workers?
Oh, you said for so the FHLB.
How long you gotta be at that profession?
So a year. Yep. So you qualify for $10,000 grant. Yep. So I got quite a few people who would use it for sure. Definitely.
All right. So I want to thank you all for coming out tonight. Everyone who was watching online, and everyone who's gonna watch this on YouTube. So Blake, I want to thank you for your time, man. Thank you for the knowledge. Thank you for dropping game. And, you know what I mean? Let's get this money, man.
Definitely.
Straight up.
Like, yeah.
Good night for you.